It's time for the Property Podcast, where every week tens of thousands of property investors, new and experienced, join together to get news, knowledge and laughs at our expense. With me, Rob Bence.
And me, Rob Dix. Join us every Thursday morning for your weekly dose of property ideas and motivation. Then head over to our website at thepropertypodcast.com to keep the conversation going. Now though, let's get started.
Hello everyone and welcome to the Property Podcast. It is episode 101. Yes, we've cracked it. We're in triple figures. I knew the name of our podcast. If you listened last week, you know what that's about. Good morning, everyone, or good afternoon, or good evening, depending on when you listen to this. Rob, but it's good morning for us. How are you?
I am very well, thank you. I'm still in a state of high excitement following on from our book launch last week. I'm also very excited about this episode. Brainy property investors ask Rob and Rob questions. All will be revealed about that, as well as a resource of the week, of course. Loads to pack into this week's episode, but let's start with that book launch, shall we? I think we need to start by extending a huge thank you to everyone who's picked up a copy of 100 Property Investment Tips, a book which we were really excited about, really proud of, and it seems like everyone else is excited as well, because the book raced to the top of Amazon behind only Smut. That was the only thing ahead of us in the charts last week.
Yeah, so it was the number one free business book in the UK. And I actually listened to it today. It probably would be, bar the fact that it's no longer free. But while it was free, it was the number one free business book in the UK, which is an incredible achievement because there's literally thousands and thousands of thousands of free Kindle books out there. So that was just incredible. And it was the top 50 free book overall across all categories. So incredible. And as Rob said, if we had a racier title, we may have got to number one. But unfortunately, because we didn't have a semi-naked woman on the front and a racier title, we did well with being at the top of non-fiction. But I'll take that. Now the book is available as well still. Kindle, it's priced at 99 pence. Paperback's priced at cost. So we've mentioned before, this is not something for us to make money from. This is just to spread the word of what we all do. You know, it's not just Rob and I, what we all do on the Property Hub, all the knowledge that's shared and expressed there, and just so a bigger audience can find it and therefore enjoy the Property Hub, and we all get more out of it because the more people in there, the better. So the Property Hub is doing it incredibly well. It's fantastic, but this book is only going to help it further. And a huge, huge thank you to everyone who left reviews for the book. The amount of reviews that came in straight off the bat is incredible. A special thank you to our ambassadors who really got behind the book. We really appreciate it to you because you really gave it that initial push. But then everybody else who came in and started leaving reviews as well after they'd read it. So thank you. If you'd like to get a copy, it's on Amazon. It's next to nothing in price. Get yourself a copy and have a read. You will enjoy it, I promise you.
Yeah, and the reviews were just fantastic. I think every time I compulsively refreshed the page, which I did a lot, and there was a new review, it just made me smile because there are people on there saying such great things about it, and it was absolutely fantastic. So thank you for that. And hopefully this will mean a new influx of people into the Property Hub. If you do see people in there and they're posting an introduction or they're asking a question, say hello to them, make them feel welcome. I know you will do. Let's get on to some other news. That's our news. That's clearly the most important. Some slightly less important, but still worth mentioning news. London property is finally set to crash, says shocking headline, which may or may not turn out to be true. But this is a story from fool.co.uk, and they do like their big scary headlines, this website. So I wouldn't take this as a fact that London property is finally set to crash. But Rob, I thought this is a really interesting story because it basically just rounds up lots of the things that we've talked about in the past, lots of the indicators of prices being potentially too high and signs that that's changing, such as the share prices of estate agent chains like Foxtons and Savills, which we've mentioned on the podcast before. So really, there's nothing all that new in here, but I liked it as a roundup of some of the factors that we've covered in the past.
Yeah, you're right, Rob. There's nothing new. And the headline is sensationalist, as you say, as well, because we've covered most of these points and we didn't give it such a incredible headline. I feel like we sometimes probably sound like we're anti-London for property investment. We're certainly not. We think London is a great place to invest long term, but because it's gone so hard so fast, there's definitely better opportunity elsewhere. You know, it's a little bit scary, the London market at the moment. And until it settles down, either by a correction, a pause, or something in between, we just are sort of keeping our powder dry, so to speak, on the London property market. But if there's investing there in the future, absolutely. London has the best fundamentals in the country, but just not now.
Yes, indeed. So this article we'll be linking to in the show notes for this episode, which you'll find at thepropertyhub.net/brainy questions. And that takes us on to our topic of the week. Brainy property investors ask Rob and Rob questions. What's all that about? Well, this is relating to the Property Hub Summit. We had the first of these events back in January, and we've got another one coming up in March. And this was a full day which is just us and 20 investors locked away in a swanky room all day talking property. The majority of the day was a mastermind session where we focused on each person individually, focused on their current situation, their barriers, and helped them overcome those barriers and put together a plan for the coming months and years. So when people came along, we didn't want to spend time going over the real basics of property investment because there's no point really. We talk about all that on the podcast, on the blog, in books, all over the place. You don't need to come and see us in person to get that kind of information. But we knew that people would still have questions. So we got people to submit all the questions that they wanted answers to, and we blasted through them all in about 45 minutes. And what we're going to do in this episode is run through some of the most interesting questions, the ones that we enjoyed answering the most, so you can learn from them as well. And at the end, we're going to be telling you about how you can get in on the next summit if you want to. But let's get on with the first of the questions. And the question we were asked were, what are the ins and outs of bridging loans? So bridging is a short-term kind of finance, which you tend to hear mentioned in passing quite a lot. People will, if you're talking about a situation and it's not suitable for a mortgage for some reason, people will say, oh, just bridge it or something like that. And you're going, well, okay, but what actually is bridging finance? It is a short-term method of funding. So a mortgage, you'll normally want to have it for at least a couple of years, up to 25, 30 years. Bridging is typically for a year or less. And it's more expensive than a mortgage, but it's a lot quicker and easier to arrange. So the difference between bridging and a mortgage is that for mortgages, they are very concerned about you as a person and the balance of your overall finances and so on. For bridging, all they care about is the property itself. And because they've got a lot of experience, they've got good margins, they know that they can just repossess the property if they need to, they often won't even instruct a formal valuation. They'll just kind of sort of get it up on Rightmove and sort of something and go, oh yeah, looks all right, fine. It's really, really quick to arrange. And they'll lend anything up to about 70% of the property's value for a period of 6 to 12 months. It is expensive relative to a mortgage. The interest rates are typically in the region of 0.75 to 1.5% per month. So it's not cheap, and then there are often entry and exit fees to add on to that as well. So it's a bit of a trade-off, really. It allows you to do things that you can't do with a mortgage, but you do end up paying the price for it. So people get scared of it because of the fees and because it's something that not everyone does. If you're not an investor, you won't just kind of come across a friend who's used bridging finance. It's something that seems a bit exotic, but it allows you to do things you wouldn't otherwise be able to do. So for auction purchases, for flips, for any kind of situation where you need to move quickly, bridging can be really useful. The one thing that you need to keep in mind for bridging is because it's expensive, if you get stuck on it, the costs are going to add up very quickly. So if you anticipate being on a bridge for a few months and you've built that into your costing, then you ended up being on it for a year. Or if even worse, it goes over a year and you have to go beyond the term you'd originally agreed with them, it gets very expensive. So the golden rule of bridging is to make sure that you have plans B and C and maybe even D to make sure that you don't get stuck on that product and there's something else that you can do. But if you've got that backup plan in place, then there's no need particularly to be scared of bridging. It's not something that everyone's going to do. It's not something you're going to need every day, but it is a useful tool to have in your armory. So that's why I'm glad that this question was asked, because I think it's important to have an understanding about what it is, why you might want to use it, and why you need to treat it with caution but not be scared necessarily.
Another good question we had was best tips on negotiation. Now, I took this one because negotiation is something I do pretty much on a daily basis, trying to get BMV deals. There are certain things you can do, but there isn't a secret word or phrase you can use to suddenly get masses of money off. One of the best things you can do, actually, is ask questions. Ask questions to really understand what the seller's motivation is. And bear in mind that the initial response that you get might not be the truth. So if you go, oh, why do you want to sell? I just want to move on and try something new. That might be the truth, but by asking really intelligent questions, and the better the questions, the better answers you're more likely to get. By asking really good questions, you're more likely to dig deep and get into the true meaning and the true purpose of why they're motivated to sell. By understanding that, then you can put an offer best suited to them. Now, of course, when you get your offer together, the offer, you can arrange it in different ways to make it appealing to them. But ultimately, in most cases, it comes down to price. So what can you do to get the price down as low as possible? One technique is to really, really start low on the pricing levels. Now, by starting low, what it will do is maybe adjust the perception of what that seller thinks their property's worth. So, for example, they might be selling a Christmas tree for £100. And if you offer £10 for that Christmas tree, they're going to say no. But what they may do is start to question in their mind whether 100 is right or not. So then if our offer comes in at 70, whereas before that might have got a no, it might get considered. Now, you can get really sneaky with this and someone else put a low offer in first and then you be the good guy and comes in with a higher offer. I know that to be done. But essentially, the concept works. You're resetting someone's expectations of a number, of a value by doing that. It doesn't always work, but it actually does work in most cases. An extra resource I can give you on this is a blog by Tim Ferriss as well. We'll link to it in the show notes, but he has his own blog on negotiation techniques, and I think it's very, very good. So I'll link to it in the show notes, and that goes into more depth.
Okay, another great answer there. And another great question coming up, which is, how do I get into HMOs? So this was a topic that came up a few times on the day. A few people who were already doing HMOs and others who were attracted to it, which I think a lot of people are. How to get into it? Well, there are 4 big factors that you need to consider. First of all, bear in mind that the financing situation for HMOs is going to be more complex than it is for regular buy-to-lets. It's because not all lenders will do them. Some will do them, but only up to a certain size or only certain tenant types. It's a complicated situation and one where you'll definitely want an experienced broker who knows about this type of financing to help you through. Another thing is, before you start doing your research and getting all excited, make sure that Article 4 isn't in force in your target area. And this is a planning restriction that means that you can't change a normal house, that single family occupancy, into an HMO. If Article 4 is in place, then it means that you're only going to be able to take over an existing HMO. So before you get excited and you say, oh, I can just get this house, split it up, blah, 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 make sure you actually can do that. Next thing, be realistic about your costs. So with HMOs, it gets very exciting when you look at the gross figures, but then it might not be quite so exciting by the time you've taken off your marketing costs, your voids, your bills, because bills are normally included. You've got to be realistic about those costs. It might well still add up by the time you've done it. You might still end up making a really great return, but you shouldn't go into it thinking you're going to get some absolutely amazing return because you haven't figured in your bills properly. Another cost which needs to be factored in is management. So that could either be an actual monetary cost because you're going to be paying someone to do it, or the time cost of doing it yourself. If you're factoring in a management fee, then first of all, you need to make sure that there is a good agent in the area who will manage HMOs properly. So not just some high street agent who go, oh yeah, I can do that for you. Someone who actually specializes in it and knows what they're doing, because it is a specialist area that needs to be done properly. And that fee is going to be higher than it is for a normal managing agent, often in the region of about 15%. So that needs to be figured into your numbers as well. If you're going to be doing it yourself, don't kid yourself that you're just saving a load of money and ignore the cost of your own time, because it is going to be more time intensive. So they are 4 factors to consider when getting into HMOs. But I'd say that the number 1 tip, if it's something you want to get into, is find someone who's already doing it to act as a mentor. That doesn't have to be someone who calls himself a mentor. It doesn't have to be someone who you pay. But if you can just find someone in your area who's already running multiple HMOs, they're going to be able to guide you through the issues that you need to think about so much better than you could if you were trying to do it on your own. That was my answer to how to get into HMOs. But Rob, another question that we had was, do HMOs have a future anyway?
And again, another good question. The simple answer is yes. The reason why is the way we're living is completely changing. So if you think about it, we have a lot of people. We're aging, more people are coming into the country, so therefore the population rises, but we're never, ever building enough homes. We've talked about this quite a lot. So therefore there's issues. Where do these people go? So properties like HMOs certainly have a place. However, while HMOs will have a place in the market now and going forward, what I do believe is that it will be more and more regulation will come in. And therefore, the barrier to get started will become higher. And it's pretty high as it is already. Getting lending on your first HMO is near on impossible. The barriers are high now, but I believe they'll get higher. I believe there'll be more regulation. And therefore, a strategy that works now may not work in the future. I know that's quite airy-fairy because, I can't say specifically what will change because I don't have a crystal ball. But just looking at the trends, look at what's happened already. I don't think it's outrageous to say more of that will continue. And I think in most cases, it's a good thing because it stops the rogue landlords taking advantage of people in vulnerable positions and people can offer good quality accommodation. Absolutely, yes, there is a future, but it will be harder and there will be more regulation. Will the returns be as high? I don't know. There might be more purpose-built stuff to accommodate for this sector, just like we've seen in student lets, where student HMOs were huge and then suddenly purpose-built student accommodation has come up everywhere. Maybe we'll see purpose-built HMO property coming up everywhere. It'll be interesting to see. That could be an interesting niche and one I wouldn't be surprised to see in the future.
Yeah, I agree. I think the demographics are such that this type of housing is going to be in a lot of demand. I think it is one where, as an HMO landlord, you're going to need to be quite adaptable and be willing to change what you offer and update what you offer to compete with changing tastes. It's not going to be a case of get into it now and just sit back. But if you get into it and you really commit to it, I think it could be a really interesting area for the future. Okay, another question that we had was, where do I go to finance more buy-to-lets when my own funds dry up? Which is a question that I think is on everyone's mind at a certain point. You might start out with a certain pot of money, but then once all that money's gone, but you still want to keep buying because it's fun and you know it's going to make you more money. But what do you do when the money runs out? Well, ideally, you have a strategy such as the money doesn't dry up and you're putting money into deals with a plan to get it back out again. But assuming that the money has gone, what do you do? Well, one thing that you could do is do flips to raise more money. Now, that is very easy to say, but it's not, of course, easy to do. It's a lot of effort, and it's not something that's easy to get right, especially when you're just starting out. But we were talking about this at the summit with some people who had significant building experience. For one reason or another, they just kind of hadn't considered doing it, even though they've got all the skills they need to do a flip really successfully. So I think that's an example of why it's useful to get together with other people. Because there might be might be a skill that you've got, which you've completely overlooked, and there might be an angle which you hadn't considered that someone else can turn you onto. So doing flips is one way to raise more capital to invest with. Another is to do joint ventures with people who've got cash, but not the time or experience. Again, joint venture is very easy to say as, I'll just go and do a joint venture. Not so easy to do. However, the context of this question was, where do I go to finance more buy-to-lets when my own funds dry up? So the assumption here is that the person asking the question has already got property experience. They've already got buy-to-lets under their belt. They're already doing well. The problem that I see with joint ventures a lot of the time is people want to do them because they don't have any money, and so they need someone with money, but then they also don't have any experience. And if you think about it, if you're someone who's got money, why would you trust your money to someone who doesn't have any demonstrable experience? You just wouldn't. And so it's quite hard to get into that unless you've built up your own credibility first. If you've got that credibility and if you've got a model that works and you can prove that it works with your own properties, then joint ventures are something that you can do. Another thing you can do if funds have dried up, just sit back and wait for capital growth. Now, that's something which you obviously can't rely on. You don't know when it's going to happen. You don't know to what extent it's going to happen. But I think it's unlikely that property right now is the most expensive it's ever going to be. So at some point, there will be some growth. So as a last resort, you can just kind of sit back, bide your time, save up the rental income as well to boost your savings and do it that way. So depending on how much effort you want to make and how much risk you want to take, there are ways to keep going when that initial cash pot is gone.
And of course, the other option is below market value. Find below market value property. So therefore, you've got equity in from day one. You can't access it at day two, unfortunately, but you can access it a lot sooner than waiting for capital growth. However, how do you go about acquiring BMV, below market value property? Again, easy to say, harder to do. And clearly, at RMP Property, it's something that negotiation I talked about earlier is something that we're trying to do all day, every day. Sometimes we achieve it, and then sometimes we just have to wait until the right deal comes along. But there are things you can do. And the good news is you don't have to use companies like my own to acquire it. You can do it by yourself. So you can do any of the following. First of all, build relationships, in particular with estate agents. Now, you have to be careful with this because estate agents, I'm sure, and in fact, I've been told, I know, get calls almost daily to say, I'm an investor, I'm looking for deals, let me know, I'll act quickly. And then they go off the radar, and sometimes the estate agent will follow up and put an offer in and go, oh no, I'm not looking for that, that's not good enough. And then the estate agent just discounts you. If they don't discount you off your first initial conversation because they don't believe you that you're serious, after the first offer they put to you and you discount that property, then they probably will for sure. So how can you avoid that? And what can you do to build up relationships with estate agents? Well, first of all, don't think that one phone call or one pop into an office is enough to build that relationship. Find out where the best estate agents are in your target area and make an effort to build a relationship up. Go in weekly. Describe your ideal properties. Give them a criteria of exactly what you're looking for so you don't waste their time or your own. Build that relationship, and then they are more likely to come to you with that deal first. Much more so than the person who called in once or rang in once to say they're looking for deals. The effort goes a long way. It's doing the extras. Most people don't do the extras. BMV property is a great thing to do. It's not easy. If it was, everyone would do it. And the reason why most people don't get it is because it's not easy. So doing things like this can make a difference. So that's estate agents. Do it with letting agents as well, though, because you'd be surprised. Letting agents, although they don't sell, they have investors and landlords on their books. And sometimes some of them will want to get out of deals quite quickly. Or some of those investors might have a deal, but they need other people involved. By building a relationship up with letting agents, that's possible too. Auctions is another way of getting BMV property. Now, it's not a guarantee because many properties in auction actually go for more than what they're worth in some cases. But if you do your research, you shortlist properties, you know that it's below market value, you stick to a rigid limit, then you might get lucky. You might go to 4 or 5 auctions and then get 1 or 2 deals. It could happen, but just make sure you do all the checks. We talked about auction property before. Make sure you go and listen to that podcast so you don't make any of the common mistakes. Another way is go to developers. Now, you could say, well, don't you do that? How is it possible for me? But actually, by going to developers yourself, you can get a deal. Developers want to get rid of their properties at certain points. When a development is just starting, so it's off plan. When a development is ending, so they can get off site. But also for the big developers on their year ends. Most developers' year end is a calendar year end, so it ends in December. So come late November, there's certain sites across the country that will do deals. Be aware of that. Maybe if you're keen to this, and as I said, it's not easy, but maybe book 2 weeks off at the end of November. Make sure you have cash available to complete quickly, and then therefore you might be able to get below market value property. There are numerous ways of doing it yourself. You don't have to rely on investment companies. Yes, I'd like to think the one I have is very good, but if you want to go alone, you can do it. It's just time and effort. It's not magic. It's not a black book of special contacts. It's just time and effort. And that's all we do is put time and effort into our network, into, viewing places, into putting offers, and then eventually we get the investments for our clients. You can do the same. It's there to be done. Many people will make you think that it's some sort of magic, but it's not. It's just hard work.
There you go. All the tricks of the trade right there. You can't say fairer than that. Final question. What a great one to end with. I love this. Assuming the 18-year property cycle will hold, what is the best strategy for getting through the falling prices stage? You can't short sell property. No, you can't. But there is a lot that you can do. And first of all, if you're not familiar with the 18-year property cycle, in the show notes for this episode, we will link to our episode on the 18-year cycle, which I think you'll find fascinating if this isn't an idea you've been exposed to before. Okay, so what can you do? You know that at some point in the cycle, prices are going to fall. But what can you do about it? Well, the absolute number one rule is not to be buying at crazy prices when things are getting towards the peak. So the beauty of being aware of the existence of the property cycle is that you're going to be able to tell when things are getting crazy and when the peak might be coming. And this is where most people fail, because most people see prices going up like crazy and they go, oh, well, I need to get in on this because prices are just going to keep going up. And if I don't buy now, they'll go up further and further. And that is the psychology that feeds the whole thing and leads to the peak and then the crash. By having the knowledge about the 18-year cycle, you can avoid that. And if all you do is avoid buying a property that's too expensive, that gives you a poor return, that should never be that price to start with, then that is a huge benefit in itself, even if that's all you do. Another thing you can do, though, is not leverage up like mad when things are getting to the peak. So again, if you see that things are going nuts, you probably don't want to be extending your debts at that point. You want to make sure that you've got cash in the bank, because we're going to come to that in a minute about where you're going to want to use that. But you don't want to go absolutely crazy. And it's a good opportunity to make sure that your finances are in order. Falling prices are nothing to be particularly scared of. Prices go up at some points in the cycle. They go down at some points in the cycle. But if you can see it coming, you can make sure that you're prepared, because it's critical that you can meet your obligations. Another thing that you could do is selectively sell properties. So because of many factors like capital gains and transaction costs and time and all manner of other things, you probably are not going to want to sell your entire portfolio on a hunch that prices are going to fall. But when people are getting a bit carried away, it could be a good opportunity to selectively sell. So if you've got a property that, in retrospect, isn't performing that well for you, it's not the best one you've ever bought, then when anyone will buy anything, perfect time to offload at a good price, and that will also give you cash in the bank. And cash in the bank is exactly what you want, because when things do hit the peak and crash, that is when you're going to be able to pick up properties at real rock bottom prices. And you want to put yourself in a position to reap the rewards. So although you can't short sell property, by just having this knowledge of the cycle, there is so much you can do to make sure that, first of all, you don't become a victim by doing the wrong thing at the wrong time. And second of all, really profit from other people becoming victims, by people who don't know about the cycle, by hoovering up all the great deals that come up once the crash has happened.
Some brilliant questions across the board there. And this is just a snippet of some of the things we answered on our mastermind day back in January. And we're really looking forward to getting all the questions in advance from all the people joining us in March. The good news is we've got the second half of the places to open up and release now. If you want to join us for the day and get all your questions answered, build out your own personal strategy with us and other investors, then make sure you come along to our webinar on the 25th of February. It'll be in the evening to make it easy for you all to attend. And if you want to come along, it's simple registration. Just go to thepropertyhub.net/summit webinar. That's Summit Webinar. So that's thepropertyhub.net/Summit Webinar. It's free to come along and find out what it's all about. And by the end of it, if you think, yeah, this is for me, we'll give you the code and the link so you can book your own place on the night. Okay, so we hope to see you there. That'll be a great evening and a great opportunity to find out what's happening at our next summit. But now, our resource of the week. And our resource of the week comes from Adam Sturdy. So thank you, Adam, for providing this one. And Rob, it's the National Self-Build and Renovation Centre.
Yeah, made for you, this one, Rob. I know what a fan you are of DIY. But this is a really great recommendation from Adam. I'm not a DIYer by any stretch of the imagination. But I think the difference between us is you've got no desire, Rob, and I kind of wish that I could do it, and I am really interested in the whole thing. And so I'm tempted by the National Self-Build and Renovation Centre. Basically, Adam says that it's in Swindon and it's this whole facility all about renovations and self-builds. So I know that there are some people, well, there are a lot of people in the Property Hub who do their own renovation work. There are also self-builders in there as well. And he said this centre is totally geared around that subject. One of the things that they've got there is like a model house, which has got opened up and it's got cross-sections and things like that to show you all the different stages of development. If you are interested in doing a self-build or doing some major renovations, that's going to be really educational and useful. Apparently they run courses as well. So if that's the kind of thing that you're into, that's going to be really useful. And there's a link to their website where it's got all the information about how to get there and dates and the courses they run and everything else, which will be in the show notes for this episode at thepropertyhub.net TPP101.com/brainy questions. So, Rob, we can set a date. We can go there together in a few weeks.
Few weeks. Yeah, busy generally in a few
Washing
weeks.
Your hair?
Yeah. Let me know how you get on. No, if that's what you're into, then I think it sounds like a brilliant place to visit. Of course, it's not really my thing. Changing light bulbs is my limit, and even then it's a challenge. So to those who do it, I admire you. I take my hat off to you. It's not something for me, though. I like to keep it easy and just move on. So that's my strategy. But for those who do like to do refurb projects, it sounds like an awesome place to visit. Another thing that's awesome, though, Rob, is our iTunes reviews, and people still continue to leave them in their droves, and thank you so much to everyone who does. We really do appreciate it. In fact, if you wanted to leave a review, you could double up and leave a review on the book now if you've read it too. We're getting greedy, aren't we? But thank you to everybody who does get behind either the podcast or the books. We really do appreciate it. This week's review comes from Antoine. Antoine from Moscow. Gents, after a few episodes, I am hooked. It's refreshing to hear and no-nonsense messages, straight to the point, clear and explicit. I have a few properties and intend on getting more than ever to continue growing my portfolio. It's an inspiration to see how you manage to affect so many people with your podcast and the propertyhub.net. I applaud you for your work and your commitment to grow and help others to succeed. Good luck with whatever's coming next, Antoine. Well, thank you so much. And from Moscow as well, Rob. We're getting really international.
Yeah, fantastic. Absolutely love it. Thank you, Antoine. Thank you, everyone who's left a review. If you've left us a review but you haven't heard it read out yet, we'll get there. We will get round to it for sure. But we absolutely love every review we receive. So thank you so much. That's us for this week. Next week, this is going to be a popular one, Rob. The best places to invest in 2015. I know that's a question that we get asked all the time, and we're going to put ourselves out there and try to come up with some answers for you.
I'm really excited about next week's podcast because this is something I talk about all the time. I think about all the time. So I know we've talked about it off air loads, Rob. So it's going to be packed full of value. You do not want to miss next week's episode. But something else you don't want to miss if you are interested in a property summit is our webinar on the 25th. Make sure you get on the webinar. It's free to join to find out what we're going to be doing on the 25th. Get your questions answered about what's involved. Go to thepropertyhub.net/summit webinar. That's thepropertyhub.net/summit webinar. And of course, you can find that link and all the other links we talked about today at thepropertyhub.net/brainy questions.
So yes, you can. So go off, have a read of the show notes, follow all the links, get in the Property Hub, keep on learning, keep on putting things into action, and we will see you back here for another property podcast next week. But for now, bye-bye.
Bye-bye.
Thanks for listening to The Property Podcast. Make sure you join our mailing list at thepropertypodcast.com.
And remember, we love 5-star reviews. Rob even loves them more than air miles.